Step into any marketing suite for a new development in London, and you will be sold a vision of frictionless living, wrapped in pristine plaster and energy-efficient glass. But there is a costly illusion baked into that glossy brochure. The moment you turn the key in the door of a brand new apartment, you trigger a financial countdown that most buyers completely ignore. We are going to conduct a contrarian analysis of what the industry calls the new build premium and why this initial price hike so frequently disappears the moment you try to sell. According to Land Registry data from the final quarter of 2023, buyers in England and Wales paid an average premium of 18.5% for a new home compared to an existing property. In certain high-density urban areas, this figure spiked even higher. You are essentially paying for the privilege of being the first person to use the oven. But this premium is not a reflection of intrinsic, enduring value. It is a temporary markup applied by developers to cover construction costs, marketing budgets, and their own profit margins. This markup fundamentally alters your starting position in the market. When you pay that 18.5% extra, you are starting your investment journey in negative equity relative to the broader secondary market. To simply break even on your purchase price, you need the wider property market to rise by that exact premium percentage. If the market remains flat, or if growth is sluggish, you are left holding an asset that is worth less on the open market than what you paid the developer just a few years prior. Understanding this requires looking at the structural depreciation that occurs as a property transitions from new to used. A home is a physical asset, and like a new car driven off the forecourt, it loses its pristine status almost immediately. The warranties and guarantees that provide peace of mind to the initial buyer begin to tick down. Scuffs appear on the walls, appliances experience wear and tear, and the communal areas lose that untouched sheen. The premium disappears because the very characteristic that justified it has vanished. We can see this stark reality when comparing the resale value of these properties against older stock in the same postcodes. Let us look at a typical regeneration zone like Tower Hamlets. According to proprietary sales data from 2018 to 2023, period properties in the borough saw steady, incremental growth. Meanwhile, apartments purchased brand new in 2018 frequently returned to the market 5 years later at asking prices identical to, or sometimes lower than, their original purchase price. The newer assets struggled to hold value once they were forced to compete without the developer's marketing machine. One of the heaviest anchors dragging down these resale prices is the burden of service charges. A service charge is a mandatory fee paid by leaseholders to cover the maintenance of communal areas, building insurance, and on-site amenities like gyms or concierges. Developers often subsidize these charges for the first year or two to make the initial purchase look highly attractive. But once the development is handed over to a managing agent, the true operational costs are passed directly to the leaseholders, often resulting in steep, unpredictable annual increases. These escalating fees do not just frustrate current owners, they actively deter future buyers. When a property returns to the market, prospective purchasers factor the monthly service charge into their overall affordability calculations. If the fees have doubled in 5 years, the amount a buyer can afford to borrow for the mortgage decreases. Consequently, to make the property viable for a new buyer, the seller often has to drop the asking price. The escalating maintenance costs directly cannibalize the property's capital appreciation. The data bears out this erosion of wealth. A comprehensive review of London housing transactions released by the Office for National Statistics, or ONS, in late 2023 revealed that flats in large modern blocks experienced the weakest price growth of any property type over the preceding half-decade. While Victorian and Edwardian terraces enjoyed robust demand, the modern equivalents stagnated. The market is highly efficient at pricing in the long-term liabilities of leasehold ownership, and it heavily discounts properties burdened by excessive, uncapped maintenance obligations. The echoes of previous market phases still resonate today. During the Help to Buy era of the 2010s, government equity loans artificially stimulated demand for new builds, allowing developers to push premiums to historic highs. Buyers were effectively given state-backed leverage to pay inflated prices. Now that those schemes have ended and the original 5-year interest-free periods on those equity loans are expiring, a wave of these properties is hitting the secondary market. They are entering an environment where buyers no longer have government assistance to absorb the premium. This brings us to another hidden mechanic that distorts the initial purchase price, which is developer incentives. To maintain high headline prices, developers rarely discount the asking price of a new home. Instead, they offer incentives like paying your stamp duty land tax, or SDLT, which is the tiered tax on property purchases in the UK. They might also throw in luxury furniture packages and legal fee contributions. These incentives can be worth tens of thousands of pounds, effectively acting as a hidden discount that keeps the official sold price artificially high on the registry. When you go to sell that same property 5 years later, you cannot offer a buyer a free furniture package or pay their stamp duty. You are selling a naked asset. The next buyer is looking purely at the bricks and mortar, the location, and the square footage. Stripped of the developer's financial sweeteners, the property must stand on its own merits in the unforgiving arena of the open market. This is exactly where the gap between the original registered price and the true market value becomes painfully obvious. Furthermore, lenders treat new builds and older properties differently when assessing risk. Loan-to-value ratios, or LTVs, represent the size of a mortgage compared to the total value of the property. Banks are acutely aware of the new build premium. To protect themselves against immediate depreciation, many lenders restrict the maximum LTV on new apartments to 75 or 80%, requiring the buyer to put down a much larger deposit. This institutional caution is a glaring indicator that the financial sector expects the asset to lose value the moment it is occupied. Once the property becomes a resale, the LTV restrictions generally loosen, reflecting the market's confidence that the premium has been successfully burned off. The bank knows that the second buyer is paying the true uninflated market rate. This creates a paradox where a 5-year-old apartment might be easier for a buyer to finance than a brand new one. Yet the seller of that 5-year-old apartment is the one absorbing the financial loss. The original buyer essentially acts as a shock absorber for the developer's profit margin. Contrast this dynamic with the acquisition of a period property that requires modernization. When you buy an older home, you are often paying a discount for its condition. As you invest in renovations, you are actively manufacturing equity, adding tangible value that the next buyer will pay for. With a new build, the developer has already extracted all the potential upside. You are buying at the absolute ceiling of the property's current valuation, leaving no room for you to add value yourself through improvement or extension. Looking closely at the hyper-local level, the sheer volume of supply in regeneration areas exacerbates this issue. If you buy an apartment in a phased development of 2,000 units, you will eventually be competing against your own developer when you try to sell. If the developer is still selling Phase 3 when you decide to list your Phase 1 apartment, buyers will naturally gravitate toward the brand new units with the fresh warranties and shiny incentives. Your resale unit becomes the less attractive alternative in an oversaturated micro-market. As we look at the transaction data for 2024, the market is becoming increasingly ruthless in its assessment of these assets. Higher borrowing costs mean buyers are scrutinizing every pound they spend. The tolerance for inflated service charges and depreciating premiums is at an all-time low. Investors and owner-occupiers alike are prioritizing properties with proven track records of capital retention, shifting their focus back toward established neighborhoods and traditional housing stock, where the value is rooted in the land rather than the novelty of the fixtures. Ultimately, navigating the housing market requires separating emotional appeal from financial reality. A new build offers undeniable convenience, energy efficiency, and a blank canvas, but these benefits come at a steep, often unrecoverable cost. By understanding the mechanics of depreciation, the hidden weight of maintenance fees, and the illusion of developer incentives, you can make a clear-eyed assessment of a property's true worth. Recognizing why this premium vanishes is the first step toward ensuring your capital is invested in assets that will actually hold their value over time, rather than slowly evaporating before your eyes.